Every month, millions of Americans write a check for their death pledge. That's what you're doing when you pay your mortgage. You're literally participating in a contract whose name comes from medieval legal concepts around death and property forfeiture. The word mortgage doesn't hide this morbid origin. It comes straight from Old French mort, death, and gage, pledge. But here's the thing, medieval lawyers didn't choose to name their most common financial instrument after death by accident. The reason shows us exactly how power, property, and human life intersected back then, and those intersections still shape our world today. We live in a culture where homeownership is the American dream. Getting a mortgage is a rite of passage. Stability, success, adulting achieved. Real estate agents hand you keys with congratulations. Banks celebrate your pre-approval with champagne imagery. But look closer at the contract itself, and you're entering a deal whose very name announces that something must die for it to work. The etymology of mortgage shows us how medieval Europe understood debt, property, and mortality. This understanding runs deeper through our modern financial system than most people realize, because we've never actually abandoned the medieval framework, just dressed it up in friendlier language. When we trace the word back to its origins, we discover that the death in death pledge had multiple meanings. The first meaning reveals medieval lending mechanics. The second exposes theological workarounds. The third shows how mortality itself became a business model. The story begins in 12th century England. Norman French-speaking nobles had conquered Anglo-Saxon England and were reshaping its legal and financial systems. But to understand why they chose such ominous language, we need to dig into the specific mechanics of medieval lending and the Christian theology that both enabled and constrained it. The first recorded use of mortgage appears in Anglo-Norman legal documents from the late 12th century, roughly a century after the Norman conquest. The document reads, "Un Adam baila habit une terre en mortgage par une somme de deniers." Translation: one Adam delivered to B a piece of land in mortgage for a sum of money. Dry legal language, but it represents a significant shift in how European society handled lending and property rights. Medieval lending worked differently than modern mortgages in ways that make the death metaphor much more literal. In many medieval mortgage arrangements, when you pledge property as security for a loan, the lender gained the right to occupy and use the land while you retained legal ownership. The lender could collect rents, harvest crops, profit from the property until you repaid the debt in full. Enter the medieval Latin term mortuum vadium, dead pledge. Legal scholars in the 12th century distinguished between two types of security arrangements. A vivum vadium, or living pledge, was one where the profits from the pledged property went toward paying down the debt principal. The land's productivity literally worked to free itself. But a mortuum vadium was different. The lender kept all the profits as interest while the debt remained unchanged. The land was dead to the borrower, generating no progress toward freedom. Ranulph de Glanville, in his influential 1189 legal treatise, explained that this arrangement was called a dead pledge because the fruits of the property were dead to the borrower. They provided no reduction in the debt. The borrower lost both the use of their property and any hope that its productivity might help them escape their obligation. But there's a deeper theological dimension here. Christian doctrine generally prohibited usury, charging interest on loans, based on biblical passages like Deuteronomy 23:19-20, which forbade taking interest from fellow believers. How do you compensate lenders for risk and opportunity cost without technically charging interest? The mortgage was one solution to this theological constraint. By taking the profits from pledged property rather than charging explicit interest on money, lenders could earn returns without technically violating usury prohibitions. But this legal and theological workaround came at a cost. The arrangement was structured around the concept of forfeiture. If you couldn't repay, the property died to you forever. No partial payments, no extensions, no negotiations. Death was binary. The death in mortgage carried profound implications for what happened when borrowers actually died. Medieval legal records reveal that mortgage arrangements frequently included clauses specifying the fate of debts and property claims upon death. Unlike modern mortgages where debts typically transfer to heirs or estates, medieval death pledges often operated under different inheritance principles that could result in complete forfeiture of family property. The 13th century chronicler Matthew Paris recorded cases where lenders would deliberately delay or complicate repayment processes, hoping the borrower would die before clearing their debt. Property that might have supported a family for generations could be lost forever because a patriarch died 6 months before harvest season provided the funds for repayment. The Statute of Merton from 1236 includes provisions attempting to regulate these abuses, which suggests they were widespread enough to require royal intervention. The statute specifically addresses cases where lenders were accused of contriving the death of borrowers through various means, from providing false information about repayment dates to more direct forms of interference. Even more revealing is the linguistic evolution of related terms. The Old French word mort gage spawned a family of related concepts: mort main, dead hand, for property that could never be sold or transferred; mort ancestor, for legal claims that died with the claimant; and mort d'ancestor for inheritance disputes. This wasn't just one metaphor, it was an entire legal vocabulary built around the intersection of death and property rights. Consider how different this is from our modern understanding. When we sign a mortgage today, we assume continuity. The debt transfers to heirs. The property can be sold to pay off the loan. There are extensive legal protections against foreclosure. But medieval mortgages were designed around discontinuity, the assumption that either the debt or the debtor's claim to the property would eventually die. This design wasn't accidental. It reflected a medieval worldview that saw property rights as fundamentally tied to personal relationships and feudal obligations, not abstract legal principles. When the person died, so did the web of relationships that gave meaning to property ownership. The death pledge was thus philosophically coherent in ways that seem alien to our modern, individualistic understanding of property rights. The English legal commentator Sir Edward Coke, writing in 1664, captured this medieval logic perfectly. And it seemeth that the cause why it is called mortgage is, for that it is doubtful whether the feoffar will pay at the day limited such sum or not. And if he doth not pay, then the land which is put in pledge upon condition for the payment of the money is taken from him for ever, and so dead to him upon condition. And if he doth pay the money, then the pledge is dead as to the tenant. Notice Coke's emphasis on doubt and conditionality. Medieval mortgages weren't structured around the assumption that borrowers would repay. They were structured around the assumption that something would die. Either the debt would die through repayment or the borrower's claim to the property would die through forfeiture. There was no middle ground, no negotiation, no modification. Death was the only resolution. This medieval logic of mortality and property hasn't disappeared. It's been buried under layers of modern financial complexity, but it's still there. The 2008 foreclosure crisis revealed how quickly contemporary mortgages can revert to their medieval logic. When housing prices collapsed, millions of homeowners found themselves in situations remarkably similar to medieval debtors, owing more than their property was worth, facing binary choices between total loss and continued payment on dead assets. The language of modern foreclosure proceedings still carries echoes of medieval death pledges. Properties are declared dead to their owners through legal processes that, while more regulated than medieval forfeiture, still result in the same fundamental transfer. The borrower's claim dies, the lender's claim becomes absolute. The mortgage system still functions as a mechanism for transferring property from individuals to institutions over time. Medieval lenders were often monasteries, noble houses, or early banking families, institutions designed to outlive individual humans. Modern mortgage lenders are corporations, banks, and investment funds, also designed to outlive individual humans. In both cases, the death pledge serves to gradually concentrate property ownership in the hands of entities that don't die. Consider the mathematics. A typical 30-year mortgage at current interest rates means a borrower will pay roughly twice the purchase price of their home over the life of the loan. This isn't just interest, and it's a systematic transfer of wealth from mortal individuals to immortal institutions. The death in death pledge isn't just about default or forfeiture, it's about the mathematical certainty that individual borrowers, being mortal, will eventually transfer more wealth to lenders than they received. The mortgage wasn't just a lending instrument, it was a technology for converting human mortality into institutional wealth. Medieval lenders understood that individuals die, but institutions persist. By structuring loans around the assumption of death, they created a system that systematically benefits the undying at the expense of the dying. The word mortgage preserves this logic in its very etymology. Every time we use the term, we're invoking a medieval understanding of the relationship between death, debt, and property that continues to structure our economic lives. The American dream of home ownership is built on a foundation of death pledges, a linguistic and conceptual inheritance from a world that saw individual mortality as a business opportunity. Modern mortgages aren't identical to medieval death pledges. Contemporary lending includes consumer protections, regulated interest rates, and legal frameworks that medieval borrowers couldn't imagine. But the fundamental structure remains. Individuals pledge property to institutions in arrangements where something must die for the contract to resolve. The next time you write a mortgage check, remember that you're participating in a financial ritual whose name preserves medieval concepts of death and property. The word itself is a linguistic fossil. It preserves a worldview where lending was understood as a form of controlled mortality, where debts and property claims lived and died according to rules that favored the undying over the dying. We've wrapped this medieval logic in modern language about home ownership and financial responsibility, but underneath the contemporary rhetoric, the death pledge endures. Perhaps that's why, despite all our technological and legal advances, the mortgage process still feels so fundamentally precarious. Because it is. We've inherited not just a word, but an entire conceptual framework built around the assumption that, in the relationship between borrower and lender, something must always die.